Good evening. It's Vijay here. Welcome to yet another episode of our weekend thoughts. So, every weekend, I take up a topic and try to analyze it and in very crisp manner, try to give you what my thoughts are. Please note, I'm not a SEBI registered advisor. So, these thoughts are original. If you like this kind of thoughts, please like, share, and subscribe. We are a small community and we are growing, but it will always help if more number of people get into this. So today's thinking is about mutual funds. I've talked about mutual funds last week. It raised a lot of hackles, especially among mutual fund distributors. They felt mutual funds are the best way to make money. And I've mentioned to you about that SPIVA report, where most of the mutual funds do not even cross, I mean, do not even cross the benchmark index, wherever the benchmarks they have. So, about 75% of the mutual funds do not perform better than the benchmarks. So, now the question will come as to whether mutual funds, what do they do, or why are they doing what they're doing, and why is that, why are they not so successful? After all, a large number of mutual funds should be able to beat the index, but 75 to sometimes 90% are not beating, especially in equity. Then the question comes as to what is it that they are doing which is reporting such poor results. And if you look at mutual fund managers, some of them are the brightest and the best, and they have done very well in whatever they're doing. But somewhere along the line, their funds are not performing as much as one would expect. If you can't beat the benchmark index, then there is something going wrong. I'll just touch upon what could be going wrong. So if you talk to somebody, what's a good investment strategy to get rich? Everybody wants to get rich and get rich quickly. So people say mutual funds, some people say stocks, some people say options trading. Now, mutual funds generally have been giving, if you take a long-term CAGR of 10 years, a good mutual fund will give about 14 to 16%. But that is what the Nifty also is given. So some of the mutual funds have given up to 20, 22 for long-term 10 years. But generally, mutual funds have given between, say, 14 to 16%. So let us say who's not somebody who's not interested in anything to do with the capital market but wants to invest for long term. Definitely, mutual funds are a place to be. But if you're a person who is watching this kind of podcast, then obviously you have interest in the market and you study the market. So then stocks could be the way to go. And if you also know research on options, you will know that options are not the best place to get yourself rich. So just it's like this, a cynical person will say that if somebody says I'm in equities plus mutual funds because mutual funds may give me safety, equities may give me better return. Then the other guy will say I am in lottery tickets, that is safer because mutual funds have not really performed well. Sometimes stocks have not performed well. So that is a very cynical response. But being in the market for more than 33 years, I can confidently say that it is the investing in stocks which will make you more money, which will make you significant amount of money than other investment avenues like FDs and corporate debt. Equity will always make more money over a 10-year time frame. And mutual funds, as I keep saying, that there are mutual funds specifically, say the ETFs are there, gold ETF, silver ETF, or overseas mutual funds, or funds which are investing overseas, even though they are a local mutual fund. So those funds will definitely, or a balanced fund, or a debt fund. So these are funds where one should put money in my opinion. I'm not a SEBI registered advisor. Again, I repeat, but generally, if you're talking about equity mutual funds, they have not performed that well. And now we also have another worry because you think that mutual funds are long term investors. So they'll buy something after doing a lot of research and hold for a long term. Long term in Indian, as far as Indian tax laws are concerned, it is about 1 year plus. So you'll be shocked when I give you this data that the turnover ratio, what we call the turnover ratio, is how much percentage of the fund, the assets under management, is turned over in a year. See, just look at this flexi cap funds. Overall, this is a 2023 data, but still it will give you it will give you some understanding. 371% turnover is there, which means a typical, the highest has been 371%, which means A mutual fund has moved their entire capital 3.7 times in a year. That means, and the lowest has been about 5% in a flexi cap fund. In a focused fund, only 1% is the minimum, that is the turnover. Turnover ratio, in my opinion, should not be more than 10%, because you see, a mutual fund may buy something, after 6 months, something may change, their objectives may change, the company may not perform well, the industry may not perform well, or something may cloud as far as the outside environment is concerned. So they may need to sell that off and bring something else new. But if you look at focus funds also, you have at the highest level, you have 347%, which means, again, as I said, 3.47 times you have done the turnover of that particular fund. Large cap funds, the range is between 14% and around 334%. 14% is still on slightly on the higher side, in my opinion. Mid cap funds about 1% to 226%. Small cap is between 6% to 130%, and multi cap funds is 6% to 130%, and small cap is between 1% to 147. These are the extremes. So there are funds which are in between. So recent study in 2024 said 55 equity mutual fund. They studied about 200 and odd mutual fund, close to 300 funds. There is a study by Economic Times. This data says 55 equity mutual funds have a portfolio turnover ratio of more than 100%, which means they are turning it over one full time every year. Okay, so that's huge. Why would you want to do that? And then I'm just giving you the first 15 schemes with the high portfolio turnover ratio. The number one is Shriram Flexi Cap Funds. They checked it over 3 months, June, July, and August. So there's 806% turnover. And in Shriram ELSS tax fund, so Shriram seems to be the culprit here. They seem to be churning regularly. Churning regularly will mean there will be some costs attached to it. Of course, mutual funds do not have to pay short-term capital gains. Maybe that is the reason why they're churning, whereas we can't churn so much because we pay short-term capital gains. But then there are costs of brokerage, securities transaction tax, and then you have the SEBI tax, the NSE turnover tax. So there are other taxes which are transaction costs, which will bring down the profitability of that mutual fund. Probably because of their high turnover ratio, you are seeing even good fund managers are underperforming the benchmarks, because in the benchmark there is just a static figure. It goes in line with how the index goes. So Shriram is a culprit. Shriram ELSS tax saver fund is a Quant became famous only because of their high turnover ratio. See, Quant large cap turns it over 607%, 6 times in a year. Focus fund is moving it 5 times. Quant value fund is supposed to invest in value stocks, and you cannot change value 4 times in a year, but that is what they're doing. Flexi cap fund, 392%, close to 4 times. I can understand in flexi cap, but a quant value fund should not be having that kind of a turnover. Quant large and mid cap, quant active. Quant is, I think, the biggest culprit, followed by Shriram. The Union mid cap fund, that's another thing. The WOC, I don't know. Union large and this one. And then you have the JM focused, and then the Union large cap fund. So you have some funds like Quant, JM focused, Union, and Shriram, who are doing a large amount of turnover. You need to just check out their NAV movement, whether it is really worthwhile to invest in these funds which have a large turnover. So what is the difference between a trader and a mutual fund? A mutual fund, long term it should be, but it is not. As I said, lots of funds are doing 100% in a year. And even, when you take the entire population, there are funds which are regularly turning it over. So when you choose a fund, when somebody chooses a fund, again, this has to be kept in mind. So this is as far as this one is concerned. So what happens is, when you see such kind of trading going on, then you begin to wonder whether this, again, is a very skeptical thing. I specialize in mutual funds, and they're saying some people, mutual fund guys, MFDs, poor guys, they don't know. Probably they don't know that the mutual fund manager is churning. So the other guy says, I specialize in penny shares, because only penny shares, if you keep in your fund, then you will do this churning. If you keep good shares, I don't see any reason why you should churn, say, 10% of your portfolio. Anything above 10%, I think it is making no sense to be an to call yourself an investor and to call yourself a long term. So just keep this in mind. This is the idea we want to share. And so just when next time mutual funds, I'm not a mutual fund distributor actively doing anything. I used to hold a mutual fund distributor license, but check with your mutual fund distributor as to why these funds are doing this kind of high turnover ratio. So I hope you're enjoying your weekend. I'll come back tomorrow with the daily commentary. Till then, goodbye and good night. Thank you for joining me.